Hi everyone, in this video we will be going over A-Level Accounting 2022 February-March Paper 3-2 question number 5. This is the structured paper 3 which consists of 6 questions. All of them are of 25 marks and we're also given a time limit of 3 hours, which means that ideally we should be spending about 30 minutes in order to solve each question. And in this video as well, we will be attempting to solve this question number 5 under 30 minutes. So without any further delay, let's get started. Y Limited produces one product. Budgeted units produced and sold for the month of July were 1,000, and further budgeted information for July was also available. So we're given the sales, direct material, direct labor, fixed overhead, and budgeted profit for these 1,000 units. Then the fixed overhead is to be absorbed on the basis of direct labor hours. We are also told that the actual units produced and sold for July were 1,120. Now, for the first part of this question, we need to prepare the flexed budget to show the budgeted profit for the month of July. And remember that flexed budget is similar to these kind of budgets, but while preparing our budgeted statement, we utilize the budgeted number of units, which was 1,000. But in case of flexed budget, we now will be utilizing our actual units produced, which is 1,120. So we just need to prepare the same statement, but incorporating the fact that the actual units produced and sold were 1,120. All right, let's write down the heading first. So that's just going to be sales, direct material, direct labor, fixed overhead, and then the budgeted profit. Let's write it down. So first of all, we have sales. Then we have direct materials. Then we have direct labor, fixed overhead, and then our budgeted profit. Okay, let's have a look at the given information. We can see that the total sales value for 1,000 units is given to be 250,000. So for 1,000 units, that's 250,000, which means that for 1 unit, that is just going to be 250,000. Divided by 1,000, which results in the selling price per unit to be 250. And now we need to figure out the total revenue for these number of units. So in order to figure out that, we just multiply the numbers 250 with 1,120. Let's write it down. So the total number of units is 1,120 times our selling price per unit of 250, which results in the total revenue to be 280,000. Now the next step is direct materials. Again, let's have a look above. We can see that the direct material is 12 per kilo, and this is the total direct material, right? For 1,000 units. Again, let's utilize our unitary method. For 1,000 units, the total direct material is given to be 60,000, which means that for 1 unit, that is just going to be 60,000 divided by 1,000, which results in 60. So this is the direct material cost per unit. Now, in order to figure out the total direct material cost for 1,120 units, we just multiply these two together. Let's write it down. That will be the total number of units of 1,120 times our direct material cost per unit of 60, which results in the amount of 67,200. And since direct materials is a cost which needs to be subtracted in order to figure out our budgeted profit, I'm just going to write it down in a bracket. Now the next step is direct labor. Again, we are told that the rate for direct labor is 25, and the total direct labor cost for 1,000 units is given to be 100,000. Again, let's utilize our unitary method. So for 1,000 units, it's given to be 100,000. For 1 unit, that's just going to be 100,000 divided by 1,000, which results in 100. Now, in order to figure out the total direct labor cost for 1,120 units, we again multiply these two together. Let's write it down. So that's the number of units times our direct labor cost per unit, which results in the total direct labor cost to be 112,000. Now the last one is fixed overhead. Let's have a look above. And we are given information regarding fixed overhead right here. We are told that the fixed overhead is to be absorbed on the basis of direct labor hours. So the first step would be to figure out the total direct labor hours required in order to produce these actual units of 1,120. So we have already figured out that the cost per unit of direct labor is 100, right? And we're also told that 25 per labor hour is our standard cost, which means that the total cost per unit is just 25 times direct labor hour per unit, and this is 100. So now we can easily figure out the direct labor hours required per unit. That is just going to be 100 by 25, which results in 4 hours. Now let's figure out the total direct labor hours for 1120 units. So total direct labor hour is just going to be 4 times the number of units, which is 1120. And this results in the total direct labor hours required for our actual production to be 4,480. Now we need to figure out our fixed overhead for these number of direct labor hours, right? Now let's figure out the direct labor hours utilized in this case. We can see that the total number of units was 1,000. So the total direct labor hours utilized for our budgeted number of units is just going to be 1,000 times 4, which results in 4,000. And since our fixed overhead is to be absorbed on the basis of direct labor hours, we can now utilize the unitary method. For 4,000 hours, we got our fixed overhead to be 24,000. Now for 1 hour, that is just going to be 24,000 by 4,000. And we need to figure out the actual fixed overhead for 4,480 hours, right? Now for 4,480 hours, our fixed overhead is going to be 24,000 divided by 4,000 times 4,480, which results in an amount of 26,880. So this is the fixed overhead that we need to utilize in our flex budget. Let's write it down. So that will be 26,880. Now we can easily figure out the budgeted profit. That is just going to be the sum of these four amounts. So that's 280,000 minus 67,200 minus 112,000 minus 26,880, which results in 73,920. This concludes the first part. Now let's move towards the second one. We are given additional information. The actual result for the month of July is also available. So we're given the sales, direct material, direct labor, fixed overhead, and actual profit. Then the cost accountant is going to conduct a variance analysis for the July performance. Now for the second part of this question, we need to state what is meant by the term variance analysis. So variance is actually just the difference between our budgeted amount, whether it be cost or revenue, and the actual amount, again the cost or the revenue. Then the variance analysis is the way to identify and explain that difference. Let's write it down. Variance is the difference between budgeted amount, whether it be cost or revenue, and the actual amount. And variance analysis is the way to identify and explain the difference. Okay, this concludes the second part. We can now move towards the third one. Now we need to calculate the variances. The first one is sales price variance. Now, since we are trying to figure out the price variance, our basis will be the actual number of units produced, right? So that is going to be the constant one. I'm just going to write down the formula. That is actual number of units. And then we just multiply it with the difference of our budgeted sales price and the actual sales price. Let's figure out which one is greater. We can see that this is the actual result, which means that this also relates to the actual number of units produced of 1,120. Now, for 1,120 units, the total sales price is given to be 277,760, which means that for 1 unit, the selling price is going to be 277,760 divided by 1,120, which results in the price of 248. And this is the actual selling price. And previously, we utilized the budgeted selling price of 250. Since the budgeted one is greater than the actual one, now our formula for the sales price variance is just going to be budgeted selling price per unit minus actual selling price per unit. Okay, so the actual number of units is 1120. Our budgeted selling price per unit was 250. And the actual selling price per unit, we just figured it out to be 248. This gives the sales price variance to have the value of 2240. Now we just need to figure out whether this variance is an adverse or a favorable one. In this case, we can see that our budgeted selling price per unit was higher than the actual selling price, which means the total revenue now has declined, and this is definitely not a favorable condition, so this variance is going to be an adverse one. Now for the second one, we need to calculate the sales volume variance, and now since we are trying to figure out the volume variance, the price is going to be our basis, and the basis is going to remain as our budgeted selling price per unit. Let's write it down. Then we just multiply it with the difference of the actual volume and our budgeted volume. And in this case, we already know that the actual number of units produced and sold were greater than the budgeted number of units, which means that our formula is just going to be actual number of units minus budgeted number of units. All right. So our budgeted selling price per unit was 250. Our actual number of units was 1120, whereas the budgeted number of units was 1000. And this gives our sales volume variance to have the value of 30,000. Now we need to figure out whether this is an adverse condition or a favorable one. In this case, we can see that our actual number of units is greater than the budgeted, which is definitely what companies prefer, right? So this is a favorable condition. Now for the third part, we need to figure out the direct material total variance. And whenever we are talking about total variance, this is just going to be the difference of the direct material from our flex budget and the direct material from our actual figures. All right, so let's have a look above. We can see that the actual direct material cost is 72,688, whereas for the flex budget, it was 67,200. So let's just figure out its difference. The greater one was 72,688. And then from the flex budget, we figured it out to be 67,200. And this gives our direct material total variance to have the value of 5,488. And remember that this is the actual one and this is the budgeted one. And we're talking about direct material, which is a cost, right? And whenever we're talking about any sort of cost, we always prefer it to be smaller than the budgeted one. But in this case, our actual cost turned out to be greater than the budgeted one, which results in an adverse condition. So this direct material total variance is also going to be an adverse one. All right, for the next part, we now need to figure out our direct labor total variance. Again, we're just going to difference the direct labor amounts from our flex budget and the actual data given. Let's have a look above. We can see that the direct labor actual one was given to be 128,520, and from the flex budget it was 112,000. So let's figure out the difference between these two amounts. And again, the greater figure is of the actual data, right? That was 128,520, and from the flex budget it was 112,000. And this gives our direct material total variance to have the value of 16,520. Again, direct labor is also cost, which means that we prefer our actual figures to be lower than that of the budgeted one, but in this case, it is the exact opposite. Our actual direct labor cost is higher than that of the budgeted one, which means that this is also an adverse variance. Now, for the fifth part, we need to figure out the fixed overhead total variance. Again, since this is a total variance, we just need to figure out the difference between the actual data and the budgeted one. Let's have a look above. The fixed overhead for the actual one is given to be 25,600, whereas for our flex budget, we figured it out to be 26,880. And in this case, the greater one is our budgeted one. Let's figure it out. So the difference is just going to be 26,880 minus 25,600. And this results in an amount of 1,280. And remember, in this case, the greater one is the budgeted one and the lower one is the actual one. Again, we're talking about fixed overhead, which is a cost. And in cases of cost, we always prefer the actual ones to be lower than that of the budgeted, which is what's happening in this particular case. So this variance is a favorable one. All right. I think this concludes our third part of this question. Now we're given additional information. The directors are interested in further analysis of the variances in direct materials. So we need to calculate the two variances which combine to give the direct material total variance. All right, we already have the direct material total variance, but now we need to figure out the two sub-variances relating to the direct materials, right? So the very first one will be our direct material price variance. And since we're talking about price, the volume of direct material is going to remain our basis, right? So we're just going to take the basis as the actual uses of direct materials. So that's going to be actual uses. And then we're going to multiply it with the difference of the direct material rates. So that is the difference between the budgeted rates and the actual rates. So let's figure out those rates first. And these rates are going to be per kg. Right? And for the actual one, it is given to be 11.80. Let's have a look at the budgeted one. It was 12 per kilo. So since the budgeted one is greater, now our formula for the direct material price variance is just going to be budgeted price per kg minus the actual price per kg. And we also need to figure out the total number of kgs of direct materials that we required for our actual data. So let's figure that out. This is the rate per kilo and this is the total amount, right? Which just means that the rate per kilo of 11.80 times our actual uses gives the total amount of 72,688. So now we can easily figure out the actual uses. That is just going to be 72,688 divided by 11.80, which results in 6,160. So this is the total number of kgs of direct materials that we utilize for our actual production. Let's write it down. So the actual uses is 6,160. We had our budgeted price per kg to be 12 and the actual one to be 11.80. And this gives the direct material price variance to have the value of 1,232. Now we need to figure out whether this is an adverse one or a favorable one. In this case, we can see that the budgeted one is greater than the actual one. And we're talking about direct material price, right? So we always require our actual cost to be lower than that of the budgeted, which is what's happening in this case, which means that our direct material price variance is a favorable one. Now, the second variance relating to our direct material is going to be that of the uses, right? So that will be direct material uses variance, which means that in this case, our basis is going to be the price. And we are going to take the price per kg for the budgeted one. So that is budgeted price per kg. And we're just going to multiply it with the difference of the actual uses and our budgeted uses. All right, let's have a look above. We already figured out that the actual uses was 6,160. Now let's figure out our budgeted uses. So we first need to figure out our budgeted number of kilos required per unit, right? And in this case, we already figured out that the price per unit for our direct material is given to be 60, and also know that the cost per kilo is given to be 12, right? Which means that 12 times kgs per unit results in our per unit direct material cost to be 60. Now this gives our kgs per unit to be 60 divided by 12, which results in 5. Now, in order to figure out our budgeted number of kgs, which corresponds to our flex budget, that is just going to be the actual number of units times our budgeted number of kgs per unit. So that's 5, which results in 5,600. And clearly our standard one is lower than the actual one, which means that our formula now is just going to be the actual uses minus budgeted uses. So we already have the budgeted price per kg to be 12. We figured out the actual uses to be 6,160 and the budgeted one to be 5,600. And this results in the direct material uses variance to have the value of 6,720. And now we need to figure out if this is an adverse one or a favorable one. Again, we're talking about direct material, which is a cost, which means that we require our actual uses to be lower than the budgeted one. But in this case, our actual uses is higher than the budgeted one, which results in this direct material uses variance to be an adverse one. This concludes the first section of part D. Now for the second section, we need to explain the likely causes of the variances calculated in the first part. Firstly, let's talk about the direct material price variance. Let's have a look above. We can see that our actual price per kg has now decreased than what was the budgeted one, right? So we can see that the price per kilo has been reduced. So price per kilo reduces. And now we also need to write down the likely reasons for this reduction in price. So maybe this could be due to a decrease in market price, right? So due to a decrease in market price, or maybe we found a cheaper supplier, right? Or due to shift to a cheaper supplier. Now let's talk about direct material uses variance. We can see that our actual uses has increased than the budgeted one, which means that we utilized more direct materials. Let's write it down. More direct materials are used. And we also need to write down the likely causes for this. Maybe due to materials of lower quality. So due to materials of lower quality, or maybe due to inefficient use by laborers which cause more wastage, or due to inefficient use by laborers. This concludes the fourth part. We can now move towards the fifth part. In July, Y Limited had adopted a new strategy to increase sales by reducing the selling price. We need to advise the directors of Y Limited whether or not the company should continue the strategy in the long run. Okay, let's have a look at whatever we calculated till now. We know that previously, let's have a look at the sales price variance. We know that our budgeted price was 250, whereas the actual one was 248, which means that there was a reduction in selling price, right? And due to this reduction, our actual number of units sold increased. So the actual number of units sold was 1,120, whereas the budgeted one was 1,000. So what we can say is that due to this reduction in the selling price, 120 more units were sold. Let's write it down. Reducing the price can increase sales as evidenced in July with a reduction. Previously, we had our budgeted selling price to be 250 and we reduced it to 248, which means that there is a reduction of $2, right? So that is the reduction of $2. And we had our budgeted number of units to be 1,000 and the actual one was 1,120, which means that there is an increment of 120 units. So that is 120 more units were sold. Okay, and this can lead to an increased customer base if the quality of the products is maintained even after the reduction of selling price, right? Let's write that down. Customer base can be increased provided that the quality maintained. Now, these are the reasons that support the reduction in selling price, right? Now, let's talk about the against factors. So, first of all, we can talk about quality, right? If the selling price is reduced, this might mean that the cost should also be reduced, which leads to degrading quality of the products. Let's write it down. The quality of products may be compromised. And secondly, we're also talking about increasing the sales, which means that we also need to increase our production level, right? And maybe the company does not have enough capacity to cope with the increased production. So that could also be a factor. Let's write it down. The company may not have enough capacity to cope with the increased production. Alright, now based on these factors, we need to advise the directors of Y Limited whether or not the company should continue the strategy in the long run. So there is no right or wrong answer in this case, right? So what I'm going to write down is that the company should continue this strategy because in July we saw that due to a reduction in sales price, we were able to increase sales. So I'm just going to write down that decision clearly. The directors of Y Limited should continue the strategy in the long run. This concludes the fifth part of this question as well as the entire question number 5 of 2022 February-March paper 3-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.